You finally started thinking about investing and you came across something called a debt mutual fund. What is it exactly? And what are the returns that you can expect from it? Is there any risk? Can you lose your money? Let's find out all about this in today's video. Hey guys, welcome back to my channel. If you're new here, my name is Sharan Hegde. I'm a management consultant turned product manager. And in this channel, we explore the incredible world of finance and how it can help us better our lives. In this video, I will be talking about everything you need to know about debt mutual funds. Before we go any further, I would like to tell you that I have put timestamps in the video below so that you can navigate to that section of the video that you're interested in. If you are someone who already has a very good grasp on debt mutual funds, then you might want to do that. Actually, scratch that. Watch the entire thing even if you know about debt mutual funds. And hopefully, you might learn something new. So let's get started with the video. So what is a debt mutual fund? Well, as the name suggests, it is a fund which purchases the debt of other companies. What does it mean to purchase a debt? To understand that, let's find out how a company raises money. So there are two primary methods that a company raises money. One is to issue stocks to the common public. That is selling its stake in the company to the public. This is what is called the stock market. And the second method is to issue debt to the public. This can be done in the methods of bonds or debentures or commercial papers. For the purpose of this video, let us focus on bonds because that forms the majority of the debt mutual funds. So what is a bond? Let us try to understand that with the help of an example. Let us say that a hypothetical company today is in need of 100 crores of rupees to start a new project. And no banks are willing to give it money. So what does the company do? So the company will split this 100 crores into smaller chunks. Let's say it splits it into 1000 smaller chunks of 10 lakhs each. Now people like you and me can purchase these chunks, and the technical term for this chunk is called a bond. So purchasing this bond would entail that you give 10 lakhs of your rupees to the company, and in return the company will pay you a fixed amount on a monthly basis. And at the end of the tenure, the company will return the entire 10 lakhs rupees back to you. So that's it. That's the concept of a bond. So now there are two problems here. Not all of us can invest 10 lakhs of rupees in the bond of a single company. And the second thing is, which company to invest in? There are hundreds of companies doing this. These are the exact problems which a debt mutual fund addresses. So essentially, it is a fund which purchases the debt of hundreds of different companies. And you as an investor can invest in a unit of this debt mutual fund for as little as 100 rupees or even 1 rupee at certain times. Also, it takes the guesswork of investing in the right companies because a fund manager who is sitting at the helm of this debt mutual fund will make the decisions for you. So you might ask me, how is it different from putting your money in savings account or fixed deposits? Because what happens with the money in your savings account and fixed deposit? The bank just lends it out to other companies, right? But the difference here is that not all companies can reach out to a bank and ask for money. Take the current scenario for example. Banks are sparingly giving out money due to the rising NPA percentages. The second disadvantage is that in the entire transaction of you putting your money in the bank and the bank lending it out to someone else, bank is the middle person and it has to take a cut to maintain its operations. And by taking this cut, your returns are reduced. What is the returns in a savings account and a fixed deposit today? It's hovering somewhere between 4 to 5%. And the bank lends it out to a company maybe at 11 or 12%. So the 5 or 6% margins that it makes, it keeps it to itself. And we as investors get only 4 or 5%. What if you could remove this middleman? What if you could directly purchase this debt from the companies? That is what a debt mutual fund tries to do. Like I said before, not all companies are made the same. There are some companies which have a higher risk and other companies which have a lower risk. This risk rating of companies is provided by companies such as CRISIL. So what happens here is that a company which has a higher risk rating has to issue bonds at a higher interest rate and companies which have lower risk at a lower interest rate. So a good mutual fund manager would purchase the debt of high risk companies and lower risk companies so that the net returns for an investor would be higher and safe at the same time. So guys, if you're liking the video so far, please smash that like button and subscribe to my channel. This will help me to grow my channel and encourage me to make more videos like this. So, who should invest in debt mutual funds? Well, the usual answer to this question is a person with a lower risk tolerance. Well, I personally feel that this might be misleading because people with lower risk tolerance might invest all their money in debt mutual funds. And this might not be the prudent thing to do if your financial goals are very far away, let's say more than 5 or 10 years away. On the flip side, a person who has a higher risk tolerance might invest all his money in equity mutual funds. This might also not be the right thing to do. I personally feel that every one of us should allocate a certain percentage of our portfolio towards debt mutual funds. This is because debt mutual funds helps us to significantly lower the volatility of our overall asset. So volatility is the degree to which your investment moves up and down. Let's just say that lower the volatility, better will be the quality of your sleep. To understand more about asset allocation and how much money to put in different asset classes such as debt, equity, gold, etc., I encourage you to watch another video that I have made. I will put a link to that video in the description as well as at the end of the video. So stay tuned till the end. So, the question that we all want to know, can you lose your money in a debt mutual fund? Because we know that money parked in a savings account or an FD is kind of a sure thing. But the returns at the same time are pretty low. So right off the bat, I would like to tell you that the risk is slightly above that of an FD or a savings account. Let us understand what these risks are. There are mainly three kinds of risks in a debt mutual fund. The first risk is the credit risk. This is very simple. A company ran out of money and is unable to pay back the money to the bondholders. But like I said, a debt mutual fund does not contain the debt of only one company. It contains the debt of hundreds of different companies. So even if a few companies fail or default on their payments, the overall portfolio is still intact. The second kind of risk is the interest rate risk. Now this is a very interesting concept. So how it works is that when you purchase a bond or debt of another company, the interest rate is fixed for the entire tenure. So let's say that the bond spans over a period of 3 years and the interest rate is 7%. You will be getting 7% interest rate for the entire 3 years. At the time that the bond is issued, the interest rate is actually pretty competitive and generally above the interest rate offered by the fixed deposit of banks. But let's say 6 months down the line, there is a change in the interest rate. Now the banks are offering a higher interest rate in their FDs. What happens now? So now the new bonds that are issued in the market will be at a higher interest rate. Let's say that the interest rate is 9% now in the open market. So now the fund manager is stuck with the debt of companies at 7% interest. So now as you can see, the money which the fund manager has is growing at 7%, whereas the open market is earning at 9%. And this is the interest rate risk. So obviously, he would be unwilling to hold on to the older debt because it is generating him lower returns. After all, we investors have invested in this debt mutual fund to get better returns than FDs and savings account. So what does the debt mutual fund manager do here? So what he would typically do is that he would sell his older debt at a discount. The discount is called a haircut. And with the money that he gains, he would buy the newer bonds which are issued in the market at a higher interest rate. But since it is being sold at a cheaper price, there will be a slight drop in the value of your investment. So if you think about it, money parked in savings account and FD is actually in perpetual interest rate risk. How, you may ask me? Because inflation is at 5%. And if your money is only growing at 4 or 4.5%, which is today's scenario, you are losing against inflation. And actually you are losing money year on year. So the last risk of a debt mutual fund is liquidity risk. What it simply means is that when you ask the debt fund to return your money back, they are unable to do it. So why could it happen? So let's first try to understand what happens during normal conditions. So in normal situations, the amount of money which is entering into a debt mutual fund is somewhat able to match the amount of money which is leaving the debt mutual fund. So since there is a healthy balance of cash inflow and outflow, any redemptions, that is requests for withdrawal from the debt mutual fund, can be honored within 2 days. So now let's consider an unforeseen situation like this pandemic. During the pandemic, what happened was that the amount of redemptions, that is request for withdrawal, was significantly higher than the amount of money which was coming into the debt mutual fund. So what will the debt mutual fund manager do here? He would have to sell his existing bonds even before they are matured at a discount rate in order to honor these redemptions. And during these situations, the value of the investment for all the investors in the debt mutual fund would drop in value. A great example of this is what is currently happening with Franklin Debt Mutual Funds. I encourage you to read more about what is happening with Franklin Debt Mutual Funds. If you'd like me to make a separate video on this, please let me know in the comments and I shall do so. So an ideal debt fund manager would try to minimize these risks that I talked about and generate a superior returns that beats the FD returns as well. There are several types of debt funds, 15 to be precise, and each of these different debt funds have varying levels of the risk that I just talked about. So how do you pick these debt mutual funds? In the next video, I shall be talking about the different types of debt mutual funds, what kind of debt mutual funds that you need to invest in, and how to pick them. So in summary, I would like to say that a debt mutual fund is a crucial investment for all investors out there. Especially in India, an overwhelmingly large majority of us have parked our money in savings account and FDs. This is a sure shot way of not realizing significant capital gains vis-a-vis the inflation percentage. If you consider an inflation percentage of 5%, which is kind of the average over a 10-year period, and if the savings account is giving you about 4.5%, you are actually losing 0.5% of the money every year. You may not realize this on a year-to-year basis, but over a 5 or 10-year period, you will understand the differences. And this problem is going to exacerbate as the years go on. If you ask your parents, the interest rate in savings account and FDs was about 10 to 11%, which was astounding. Today, it's about 4 to 5%. And this situation is only going to keep getting worse. Look at the United States. The interest rate on savings account there is less than 1%. So what happens here is that as the country continues to develop, it becomes a more corporate focused economy. That is, it will focus more on making conditions and lives better for the companies. And one way of doing this is to lower the interest rate so that the corporates can borrow money at a lower interest rate. So in conclusion, what I would like to tell you is that it is pertinent to take some calculated risk to generate higher returns. And your future self will thank you for letting him or her retire early. Now that does not mean that you need to invest all your money in Bitcoins. Please don't do that. If you'd like to know exactly how much money to put in debt mutual funds, I encourage you to watch this other video that I have made on asset allocation. You can find a link to that video here. So guys, with that we come to the end of this video. If you think that you learned something new, then please like this video and subscribe to my channel. I'll see you in the next one.